All right, let's talk about a brand new ETF that's making some serious waves in the Canadian income investing world. It's called the Evolve Sixty ETF. And today, we're going to do a deep dive into how this thing works and how it plans to squeeze a really powerful monthly income stream out of some of Canada's biggest and most trusted companies. Okay, before we get started, just the quick and necessary disclaimer. All the information in this explainer is for educational purposes. It's based on our own research and the data we've pulled directly from the companies themselves. And this is super important. This is not, I repeat, not financial advice. You should always consult with a qualified financial advisor who knows your personal situation before you even think about making an investment decision. Okay, disclaimer over, let's get into the good stuff. So let's start with the core question, the big idea we're exploring today. How do you take arguably the most stable, most reliable part of the entire Canadian stock market, the big banks, and turn them into a high-octane monthly cash flow machine? Here's how we're going to break it all down. First, we'll talk about why the banks are such a bedrock for investors. Then, we'll get into the strategy used to generate that high income. After that, we'll properly introduce our new contender, Sixy, and then put it in the ring for a head-to-head comparison with its rivals. And we'll finish with the million-dollar question. Is that juicy extra yield really worth the risk for you? Okay, first up, Canada's banking bedrock. You see, to really get a handle on these specialized income ETFs, you first have to understand why they're all built on the same foundation, Canada's big six banks. It's not an accident. And this chart really tells the whole story, doesn't it? I mean, just look at that. This is the 15-year performance of the S&P/TSX Banks Index. You can see the dips for sure, but the overall trend is one of steady, reliable, long-term growth. Canadian banks are famous around the world for being stable and well-managed, which is exactly why they're the go-to starting point for so many investors. So that brings us to our next piece of the puzzle. We know the banks are solid growth assets, but for a lot of people, maybe you're retired, maybe you're an expat, you're not just looking for growth. You need cash flow. You need your portfolio to spit out cold, hard cash every single month. So how do these ETFs do it? Well, the main tool in their toolbox is a strategy called a covered call. Honestly, the easiest way to think about it is like you're renting out the bank shares you own. You get paid a fee right away, that's your income, but in return, you're promising to sell your shares if they hit a certain price. So you get cash now, but you give up some of the potential for huge gains later. It's a trade-off. And this, my friends, brings us to the main event. Meet the new kid on the block, Evolve's new ETF, ticker SIXY. This fund takes that same covered call strategy on Canadian banks and basically puts it on steroids. And here is its secret sauce. The number you see here is the key. Sixy uses 33% leverage. What in the world does that mean? Well, simply put, for every dollar you invest, the fund goes out and borrows another 33 cents to buy even more bank shares. The whole idea is to use that borrowed money, that extra firepower, to generate a much higher monthly income. Now, to really see what's going on, let's put it in context. Evolve already has a very popular bank ETF. Its ticker is BANK. As you can see right here, BANK uses 25% leverage. With Sixty, they're cranking that dial up to 33%. That's a clear signal that this new fund is taking a more aggressive approach, aimed squarely at people who want to maximize that monthly check. Okay, so now that we know how Sixy works, how does it actually stack up against the competition? Let's throw all the major players into the ring and do a proper head-to-head comparison. All right, now this table, this is where it all comes together. Just look at the leverage column. On one end, you have ZWB from BMO, the old school choice with zero leverage. Then you have Evolve's Bank at 25%. And then you've got the heavy hitters, Sixty at 33%, and HMAX and HCAL from Hamilton pushing it even further. Now let your eyes drift over to the target yield column. See that pattern? It's crystal clear. As the leverage goes up, so does the target income. This one table basically lays out the entire risk and reward spectrum for you. Which brings us to our final and, frankly, the most important section of this whole explainer. We can see the higher yield right there on the table, but is it actually worth it? It all comes down to understanding what you're giving up to get that extra income. And, this is the question every single income investor has to wrestle with. That bigger monthly payment is so tempting, right? But it never, ever comes for free in the world of investing. So what's the price? What are you giving up in return? Let's just lay it all out. The pro is obvious. More cash in your pocket each month. Simple as that. But the cons, well, they're pretty serious. First, because of that covered call strategy, your growth is capped. If the bank stocks go on an absolute tear, you're going to miss out on a big chunk of those gains. But even more importantly, that leverage is a double-edged sword. When the market goes down, your losses are going to be magnified. A 10% drop could feel a lot worse in one of these funds. And this quote just hits the nail on the head. Leverage is a tool, not a magic trick. It makes the good times better for income, but it makes the bad times worse for your capital. It's not good or bad on its own. It all depends on whether it's the right tool for your specific goals and, crucially, your personal tolerance for risk. So who is an ETF like Sixy actually for? Well, it could be a potential fit for someone who is absolutely laser-focused on getting the highest monthly cash flow possible. Think retirees or expats who are living off their investments. But, and this is a massive but, it's only a good fit if that person has a rock-solid, crystal-clear understanding of the amplified risks and is genuinely comfortable with them. And so I'll leave you with this final question to chew on, because it really gets to the heart of all investing. When you look at your own portfolio, your own life, your own goals, where do you draw that line? What is your perfect balance between getting more income today versus protecting your capital for growth tomorrow? Figuring out the answer to that question is really the secret to building a portfolio that's going to work for you in the long run. If you enjoy geeking out on this stuff, income investing, financial independence, make sure you subscribe because we've got a lot more deep dives like this coming. Thanks for tuning in.